want to thank everyone for being on here today. I especially want to thank Lamar Baxter with Accuplan San Francisco. Lamar, thanks so much for being on with us today.
Thanks for having me.
I'm going to go ahead and get started. I'm going to do a short PowerPoint today, about 20 to 25 minutes, and then I'm going to turn it over to Lamar. Lamar's going to back clean up today. So I'll do my presentation first, and then we'll get started with Lamar right after that. We're going to take questions at the conclusion of today's webinar. So if you have questions, if you look to the right of your screen, you've got a dashboard there. Down towards the bottom, there's a little button that says questions. You click on that. You can type your questions in anytime during the webinar. We won't stop to answer questions during the webinar, but we'll take all your questions at the conclusion of today's webinar. Again, I want to thank everyone for being on here today. Just sort of my agenda, we're going to talk a little bit about where we've been in 2013, not much, not going to focus a lot on that today, but I am going to talk about some market trends, some statistics for 2013, where we suspect the market's going in 2014, what the hedge fund guys are doing. You know, when I did all my research at the end of 2013 for what we could expect to see in 2014, the best sources I came up with were all the hedge fund people, and we deal with all these folks on a daily basis. But it was sort of their strategy that I sort of used to mirror where I think the market's going in 2014, so we're going to talk a little bit about that. And then I'm going to do quickly the top 10 reasons to buy and hold real estate in 2014. I'm going to spotlight two markets today, Birmingham, Alabama, and Memphis, Tennessee. We are new into Memphis as of this month. So I'm going to talk a little bit about Memphis, Tennessee, a little bit about keys to buying. I'm going to show you a little bit of example inventory, and then again, we're going to turn it over to Lamar Baxter, who's going to talk about Accuplan and some strategies you might consider for investing, whether it be in real estate or whatever your investment vehicle might be. So, okay, so the last statistics we got from Case-Shiller, 20-city home price index. Basically, this is a stat you've seen across the board. If you've read anything about real estate in 2013, that most indicators point to about 12% or greater over the 12 months from August to August in 2013. Those 20 cities that they highlighted in this particular survey saw increases anywhere from 12 up to 29%. You did see markets like Las Vegas up 29%, Denver, Dallas, in Orange County, California, up in the 20 percentile as well. You saw some of that, but overall, across the country, we saw a fairly decent rebound, bounce in home prices in 2013, up about 12%. Interestingly, and this is the thing that I found in most everything that I read, and I highlighted it second paragraph and read, it's still 47% lower than they were before the market collapsed. What's interesting is the market's come back. A lot of folks say, wow, the market's come back. Is it a good time to invest? We still think it's the best time to invest. We'll talk a little bit about that today. But the reality of it is it's going up, but it's still way below the previous peak. This was CNN Money in July. This is when we really started to see the foreclosure nightmare come to an end in June. We saw the lowest number of foreclosure filings since before the housing bust. So actually the lowest since December of 2006. That's according to Realty Track. It was down 35%, down to 127,000 homes. That's still a staggering amount of homes coming onto the market. But we've continued to see throughout the fourth quarter of 2013 a decrease in the amount of foreclosures coming onto the market. Interestingly, as many of you know, one of the more popular ways to liquidate inventory for the banks was to do short sales. There's tons of short sales. I pulled this off CNN Money from Christine Dijani just a few months ago, but this is what we found to be interesting, is that the majority of the sales of single-family homes in the United States are being purchased by cash. They're being purchased by investors. Nationwide, such transactions that have no loan recorded at the time of the sale accounted for 44% of all sales. That's a 33% increase from the same time last year. The total percentage of cash sales in September was 45%. And look at some of these states like Florida, Nevada, Georgia, Carolina, over 50% in some cases. In Florida, 65% of all sales made were completed in cash. Now, what is that saying? It's saying that investors are the ones that are buying the majority of the homes in the market today. Hedge funds, real estate investment trusts, individuals like you who may consider buying a foreclosed income-producing property for your retirement portfolio or whatnot, those transactions are completed in cash. And so we sort of asked ourselves this very question about 15 months ago when we started to realize that on the ground these guys were very obviously in our markets. Who are these guys? I mean, what are they? Why are these big institutional investors, buying single-family real estate? And really, the answer is really kind of simple. For the same reason you would consider it. And there's cash flow, there's appreciation. you have a hard asset. I mean, if you're invested in the stock market today, you're a little bit nervous, of course, because the market's sort of sliding around. And as Lamar and I were speaking before the webinar began, you know, you're going to see some volatility in the stock market. Real estate market, on the other hand, these hedge fund buyers see this as the safest place to have their money. And I like the little cartoon, you know, yeah, specializing in highly complex derivatives and exotic financial instruments for the discriminating investor. And he says, buy gold. Yeah, the simplest investment now is to buy the simplest things in the market. Real estate obviously has been around forever. Most anyone that has a large investment portfolio has some part of that invested into real estate. And most of these guys just see this as the absolute best time to invest. In the last 30 days, I've been doing a lot on these webinars, talking a lot about details of what these funds are doing. Just to give you a recap, the three largest funds that are out there is, the first one is Blackstone. They are the largest owner of single-family homes in America today. They own 31,000 homes in 13 markets across the United States. They have the largest opportunistic fund ever raised, of $13.3 billion. Many of you know Warren Buffett bought Prudential Real Estate in October of 2012. Very famously was interviewed about saying Warren is investing in real estate a good investment, and he went on to say, yeah, it's the best place to put your money, when all these reasons why. And then, of course, he went out and he bought Prudential Real Estate to give him the infrastructure that was necessary to buy, rehab, rent, collect rents, and sit on that investment. And then finally, John Paulson. These are the three groups that we profiled the last 30 days. John Paulson was the guy that accurately predicted the foreclosure nightmare back in 2007, I believe it was, and now has bet very heavily into the stock market, investing millions of his own dollars into the real estate market, and has done extremely well with that. But what's their strategy? Their strategy is a buy and hold strategy, and I'm going to talk about that. I'm going to do the top 10 reasons why you buy and hold real estate. But their strategy is really to buy and hold. They believe, Jonathan Gray, by the way, he's the CEO of Blackstone Real Estate, he's quoted here as saying that they believe the market will remain bullish for 2 to 4 more years. We agree with that. We agree that the market does have a solid 2 to 4 more years in this particular state. We believe that that's market dependent, that some markets are better than other markets to invest in, but we agree with that strategy. And then, of course, their strategy, isolate key markets for growth, renovate the properties, don't invest more than 10% of the purchase price on upgrades. I'll talk a little bit more about that later. And then sit on them. And you sit on them for cash flow, for appreciation, all the things that we're going to talk about. And I get a lot of people that call me up and ask, you know, Charlie, you know, I do work with hedge funds. I work with individual investors. My role is sort of to help people identify the best piece of investment real estate for their particular strategy. And everyone's a little bit different with what they're trying to accomplish. You know, do I buy and flip? Do I buy and hold? What's the best deal for me? But is this a good time to buy? And we believe that absolutely it is. And we think that's evidenced by the hedge fund guys that get paid lots of money to invest lots of money into certain investments, believe that as well, that this is the best time to buy and hold real estate. And I'll do the top 10 reasons why. This is by Ken Corsini. I read and follow his blog regularly. He's a real estate consultant. I'm going to use his top 10 reasons. The top one reason, the first reason to buy and hold real estate is appreciation. Certainly, when you buy a piece of real estate, you want to look for a couple things, but the one thing you want to look for is you want to look for the fact that you're going to be in a market that's appreciating. That's incredibly important. You certainly want to be able to get cash flow, ROI, you know, cash on cash return. We'll talk about that. But appreciation really is the number one reason. You buy it and you sit on it, you hold it, you let the market come back. Inflation may go up a little bit. You bought your property at a particular price point. You know it's going to appreciate over a period of time. Every time, you know, every month that property appreciates, there's more money going to your bottom line into your investment portfolio. Number two is passive income. Most people like this particular market because it's passive. Essentially, we wouldn't sell a property to anyone that doesn't have solid property management on the ground, so you're not really doing much to manage the property. You've got a property manager taking care of it for you. The home is purchased always, rehabbed and rent ready, so there isn't any work to do to the house. So there's passive income. So holding that for passive returns is a solid reason to buy real estate. The third thing is high leverage. And this sort of highlights the fact that if you're going to walk into a bank and you are going to ask for a credit line of $800,000 secured against your $200,000, that bank is probably not going to be interested in your particular investment strategy. If it's gold, stocks, mutual funds, that's not something a bank is going to be interested in. On the other hand, if you go into the bank and you say, I want to buy 10 houses at $100,000 a piece and I need a loan, they're going to say, sit down, let's fill out the forms, because they recognize that real estate is a good place to invest your money, so high leverage. Number four, and I mentioned it just a moment ago, is high ROI. You certainly want to look for appreciation, but you also want to look for ROI. We tend to focus in markets that have a little bit of both. I'll give you just an example. The Atlanta, Georgia market is a great market right now for appreciation. You can get appreciation there for anywhere from 12 to 20% depending on the pocket. And Atlanta's a great market. Nobody would tell you that Atlanta's not a great market to invest in real estate. The problem is that market is so competitive now that your ROI, your monthly, yearly, cash-on-cash rate of return is going to be 6, 7, 8%. I'll show you some examples later. But you want to look for markets where you get a high rate of return combined with appreciation. That's the golden ticket, and that's where most of the institutional investors are invested in. Markets where they get a good rate of return, but they also know the market's going to continue to climb and appreciate. Number 5 is not going to apply to most any of you. Principal paydown is essentially a great reason to buy and hold real estate, but principal paydown is essentially saying, I took out a loan to buy this property, my renter, my tenant, is going to pay that principal paydown, so I'm paying off my principal loan with no cash out of my pocket. That's great if you're going to get a loan of some sort. Most people don't. It's typically purchased through either cash or a 401k or self-directed IRA. But principal paydown is a great strategy if you're going to use leverage, meaning a loan, to acquire that real estate. Number 6 is tax benefits. I'm going to be doing a webinar next Thursday that's going to be the top 10 tax benefits in buy and hold real estate. And so I studied this at the end of last year. I will preface this by saying I'm not a tax preparer. I'm not an accountant. I'm not qualified to give that sort of advice. We're going to have a professional on the phone on the webinar next week to do that. But I did study it. Man, there's a lot of tax benefits to buying buy and hold investment real estate. So tax benefits is number 6. Number 7 is to hedge against inflation. We're going to see inflation at some point in time. You're buying real estate at a price right now where you're going to get it well below market value. Inflation is going to occur. You own the property free and clear. The property is going to appreciate. It's a great hedge against inflation. Another reason why hedge funds see this as being an outstanding place to invest your money. Number 8, everything you read about the market right now will tell you that rent values are going to do nothing but go up. Increasing rents are going to go up. What does that mean? It just means in the future years your ROI is going to go up. So for right now, you're renting a house at $750 a month. You're netting out $625. You're getting 12% cash on cash. In 2 years from now, that rent will probably be $800 a month. So the rental market is going to continue to climb, which means your rents are going to go up, which means your investment is going to have a greater value. Number 9, retirement income. That's something Lamar can talk about. Certainly we see more and more, and Lamar and I were chatting about it. You see more and more people saying, you know, stock market, real estate market, where's the best place to put my money? I want to rebuild my 401k. I want to have something there for my retirement. Where's a good place to invest? Well, we believe real estate is the best place to invest, and I think most of the institutional buyers will tell you the same thing. And then number 10, creative exits. No time in the history of the real estate market, any realtor, anybody that's been in this market will tell you different. Has there been more ways to exit when you want to exit? Regardless of what your strategy is, I want to do a buy and flip. I want to be in for 90 days, Charlie. How do I do that? Not a problem. You can do buy and flips. Or buy and hold. I want to be in for 3 years. I want to be in for 5 years. I want to be in for 7 years. But whenever you want to exit, the reality of it is there's so many buyers in this market now that when you want to exit, there's a number of ways for you to exit, from putting a for sale sign in the front yard to putting it on the market to these institutional buyers to profiling on a webinar like we have today and say, here's my property. I want $50,000 for it. There's lots of people out there to buy and hold real estate. Just going to profile two cities today. We are actually in 5 different markets at the moment. Toledo, Ohio, Birmingham, Alabama. We're going to introduce Memphis, Tennessee today, Detroit, Michigan. There's some great buys in Detroit right now. But I'm going to spotlight 2. And the first one we're going to spotlight is Birmingham, Alabama. We do a lot of work down there. We've been in that market for a number of years now. It was a sleeper market 18 months ago. It's not anymore. CNN Money for 2014, I just pulled this off last week, calls Birmingham the number 8 market in the United States to invest in real estate, and there's a lot of reasons for that. They've done a lot of revitalization downtown. I'm going to show you a couple photos here in a minute. Turning old warehouses into office, opening new parks, building a minor league baseball stadium. I'll show you that. But Birmingham is a market that saw a 12% increase in 2012 to 13. Saw a 17% increase from 11 to 12. CNN Money is saying they're predicting a 7.8% increase ending in September of 2014. That's the projection for Birmingham. CNN Money says it's the 10th best overall real estate market in the country, 3rd fastest growing real estate market in the nation. New Wire says the 3rd best cash flow market in the country. I'm going to show you why in a few slides. This is the baseball stadium. This is right downtown. It was finished about 6 months ago. Beautiful stadium. That whole area has been revitalized downtown, restaurants, shops, bars, nightclubs. The whole city's really been revitalized. So in 2013, I mentioned how did it do there. Did a lot of business down there in 2013. Overall, the real estate market climbed 12%. This was off of Trulia, by the way. Pulled this off right at the end of the year. They actually saw a decline from September to December. There was a decline of 5.9%. Most people attribute that to the fact that in November our government shut down. That did have an effect on most markets throughout the United States and real estate markets. But even with that 5.9% decrease, it saw a 12% increase for the entire year. Sales prices in Birmingham have appreciated 57% over the last 5 years. One of the reasons why not only we are in Birmingham, but most of the institutional buyers are there as well. We're now in Memphis, Tennessee. I'm going to show you a couple properties there as well. If anybody knows anything about the real estate market, you know Memphis has been a destination point. We have not opened that market for a number of years, and the reason we haven't is simply because we did not have access to the banks to get the properties and buy the properties right. And B, we didn't have the teams in place to do the work that needed to be done. That's now all fully in place. So we're now in the Memphis, Tennessee market. Now, CNN Money rates Memphis the 10th best overall real estate market in the country for appreciation. So for appreciation in 2014, they've rated Memphis, Tennessee number 10 on their list. So they expect to see a tremendous, well, through September of 2014, they're predicting a 7.3% appreciation in values in Memphis through September of 2014. This was off the Memphis Business Journal, just saying they expect home values to soar in 2014. It says Memphis is one of the cities they expect to see the biggest increase in home prices this year. That's from CoreLogic, Case-Shiller. So they rate Memphis as one of the top cities for appreciation. CoreLogic expects the value of the Memphis homes to increase another 7% by September of this year. So that's a pretty consistent stat. What will it do through the end of the year? You know, who knows? But I think you can pretty much bet on Memphis being a solid 10, 12% increase in appreciation in 2014. A couple more slides, and then we'll move on to Lamar. We'll get to Lamar here. Keys to buying in today's market. I get asked all the time, you know, what are the keys? And they're really pretty fundamental. And I actually got some of this, obviously, from some of these other guys that are extremely aggressive in this market. But number one, you got to buy below market value. Number two, don't buy anything that's not off market. If you buy something that's listed, you're buying it retail. You do not want to do that. You want to look for both, as I talked about. You want to look for both year-on-year ROI as well as appreciation both. You want to get a combination of both income streams. You want to have your infrastructure in place. If you're going to do this on your own, make sure you've got people you can trust to do the rehab work, rent the property, and collect the rent. It's incredibly important. As I mentioned, we won't sell a property unless we know we've got infrastructure in place. House is finished, turnkey, renting, and you're getting a property management team there on the ground to be able to collect the rents, take care of all the property, the issues for you. Understand your strategy. It's really important. People will call me after these webinars and say, you know, I'm looking to buy something. The first question I ask is, what are you looking to accomplish? You want to be in short term? You want to be in long term? Not that your strategy may not change, because it very well could change, but understand what your strategy is. And then number 6 is also number 1. You have to buy below market value. It's the number 1 key to being successful in this market, is buying under what the value of the property. I'm going to give you a couple of examples here in a minute, but buy and holds, if you're curious, they start anywhere from $33,000. That's typically in the Toledo market and the Detroit market. 33 to 35,000 is typically what the start-in prices are in those markets. We do not do anything over about $100,000. I have very few people that want to do high-end buy and flips, especially. So we try to keep it under $100,000. You want to always get a 1-year home warranty. As I mentioned a number of times now, property management is key to success. The house has to be fully rehabbed. You do not want to buy a fixer-upper unless you want to do a flip. As I mentioned now a number of times, valuations have to be below market value. You have to have equity in the property when you walk in the door. If you do that, even if there's a slip in the market, something occurs in the economy, and the values take a temporary dip, as we saw from September to December in 2013, if you're buying below market value, that doesn't matter. It won't affect you. And then, of course, mailbox money. Live like a hedge fund guy. You know, look for properties that are already cash flowing. You can see what the numbers look like when you walk in the door. I'll just give you some examples. Because people ask me all the time, you know, I'm in Southern California. What do you get for $50,000 in Birmingham? This gives you an idea. Built in 1978, 3-bedroom, 2-bath, 1,200 square feet on a 10,000 square foot lot. That's going to sell for $49,900, not $59,900. That's going to give you an ROI of about 15%. That gives you an idea. $50,000, you're getting 15% cash-on-cash ROI on your money every month. Great little cash-flowing property. This is a little bit bigger property. This is 62.5, 4-bedroom, 2-bath, big house, 1,800 square feet. You get an idea what the rehabs look like down there, by the way. That's pretty standard flooring, tiling, paint, new bathrooms, sinks, countertops, that sort of thing. It gives you a good idea of what a rehab after rehab model looks like. As I said, this one's not going at 62, it's going at 52. Based on a $52,000, that's about another 15% ROI. And then you get an idea here. ePraisal says that house is worth 76. Zillow says it's worth 66. You can buy that for 52. So you're buying it under market value with about a 15% cash-on-cash rate of return. Now in Memphis, Tennessee, it's a little bit less expensive to buy into that market. This one here is at 35.5, very similar to what you're getting in Birmingham. It's a 3-bedroom, 1-bath. But it's a 15% cash-on-cash ROI at $35,000 buy-in. ePraisal says it's worth 53. Zillow's estimate says it's worth 36. And truly fair market value says 52. So you're buying in well below market value, and you're getting something that's going to cash flow at over 15% year-on-year rate of return on your money. Same type of thing here on Mark Twain Avenue. Just looked at this one this morning at 36,000, a 3-1, fairly big for a 3-1, 1,400 square feet. But again, you're talking about a 15% rate of return, cash on cash. ePraisal said it's worth 50. You can buy into that at 36,000. That just gives you some ideas of what some of the inventory looks like, what's available out there. We have a new website just going up in the next couple of days. Oh, I do have one more. I'm sorry. To give you an idea here, this $49,900 in this one, built 1950, 3-bedroom, 1-bath. Again, if you look at the rehab work, very, very similar. In Birmingham, by the way, there's 6 teams down there that do nothing but do rehabs on these properties, and the rehab work is fairly consistent, one home to the other. But again, this one is $49,900. Zillow says we're 75. Truly, it says similar homes like this being sold now are being sold at 79, and that's being offered now at $49,000. And you can see what the numbers look like that. At $49,000, this is about a 13% rate of return. And yes, when I quote those numbers, and that's why I have this slide up, when I quote those numbers, I'm quoting net numbers. When I say ROI, those are net. So there's your rent, you take out your taxes, your insurance, your property management fee. So when we talk about a rate of return, I'm not talking about before you pay your overhead and costs, which are taxes, insurance, and management. Those are net, net, net numbers. This one at $49,900, that gets that ROI up to about 12.5%. So just, again, gives you some ideas on what the inventory looks like and what you can expect to see in terms of rate of return and what the market says these homes are worth. As I said, the number one thing is you got to buy below market value, and the homes that we will always offer out there are going to be well below market value because they're not purchased on the MLS. They're purchased either from banks or private sellers, all purchased off market. So that's my presentation. A couple of questions came into the queue while I was talking. So again, I want to remind everybody that we're going to take questions at the conclusion of Lamar's presentation. And as we're switching the screen here, I want to say thanks again, Lamar, for being here. Lamar's our special guest from Accuplan up in San Francisco. Lamar, thanks for joining us today.
Thanks for having me, Charlie. Good information covered by Charlie. And it's interesting that we're talking about this today as a result of what's happened in the market, just say within the last 1 or 2 weeks in terms of the drop in the Dow. It's been anticipated over the last 6 to 12 months that there's going to be a correction coming, and it looks like going into 2014 that correction has begun. And this is not to say anything negative about Wall Street or the stock market, but it's really important when you're using retirement funds to diversify your investment portfolios. And it's some of the things we're going to be talking about during my presentation in terms of truly diversifying your investment portfolio using a self-directed IRA or 401k. Just go ahead and get started here. Okay, hold on here. Okay, look like I'm having problems advancing my screen. So I'm just going to actually...
Lamar, try this. Put your mouse, hover your mouse over the screen, and then click on it, and then you should be able to scroll.
I don't even see my mouse here.
Yeah, when that happens to me, that's generally because because your screen just came up. You want to hover your mouse over the screen, and then click on it. Do a left click on it, and then you should be able to scroll. Try that.
Okay, actually my screen just, okay, hold on, my screen just went blank here. Change presenter back, and usually that'll correct it as well. Because I got my mouse back now here.
Okay, Lamar, you should see my screen now, correct?
I see your screen, correct.
Okay, so we're going to hand it back to you.
Okay. Okay, so here's my second screen. So just to give you a little bit of background on myself, my name is Lamar Baxter. I'm the Director of Business Development for Accuplan Benefit Services. Our objective is to be able to offer the self-directed IRA and 401k plan. Just kind of give you a little background on myself. I've been in the business for approximately 6 to 7 years, working directly with both the small businesses as well as individuals looking to truly diversify their retirement plan and taking advantage of alternative investments. What I'm going to actually do is cover some information as to why a lot of our clients are looking at the self-directed plan to truly to diversify their investment portfolio. And before I get started, I just want to basically convey some information in terms of what our position is on self-directed plans and self-directed investments. I'm just going to read this disclaimer. Accuplan Benefit Services and its affiliates do not provide investment advice or endorse any products. It's really important that you consult with your tax and legal professional and any other financial planner or advisors before moving forward with any investment. Our role is primarily to educate you on the options that's available to you using the self-directed plan. We're a national organization. Our parent company is American Estate and Trust, which provide our custodial services. We provide what's called the third-party administrative services for the self-directed IRA and 401k. We pride ourselves on expertise in terms of low-cost, quick service for the self-directed plan and 401k. We maintain a staff consisting of various individuals from various aspects of the financial arena, including former employees and executives from different areas in terms of the tax profession to assist us to make sure we have a top-notch compliance team to make sure that any and all transactions are compliant and basically adhering to the rules of IRS Code 4975. So here's some statistics I usually share as to why a lot of our clients are looking at the self-directed plan. It's estimated that 10,000 baby boomers over the next 20 years will turn 65 and not be in a position to be able to retire at the age of 65 or beyond. Most will be forced to continue working if that's an option for them, depending on their occupation, beyond the age of 65 years of age. And they're going to be facing such challenges such as skyrocketing healthcare costs, diminished Social Security, and Medicare benefits. So a lot of the perks and benefits that previous generations were able to enjoy in their retirement years may not be available for all of us. So it's really important that we educate you in terms of taking a proactive approach in terms of growing your retirement, educating you in terms of what options you have available beyond the traditional investments that's been offered to you through your IRA or 401k, through stocks, bonds, annuities, and any other Wall Street or traditional investments. Inflation and cost of living will definitely threaten to erode your fixed income as you go into retirement, so you want to make sure that you have a principal nest egg to be able to continue to invest and provide you some form of residual income to basically supplement any Social Security, any other retirement income that you're going to be having coming in beyond the age of 65. It's estimated at $4.7 trillion in both IRA and combined 401k funds are basically within various retirement plans. And of that total amount of $4.7 trillion, only 1% is invested in self-directed or what they consider alternative investments. So definitely we as a society, we have a long ways to go to basically reverse that trend and really start thinking outside of the box and start taking advantage of a lot of lucrative investment options that are considered alternative investments that can usually give you a lot safer as well as a higher return than the stock market can. It's estimated up to 90% of the population is unaware of a self-directed IRA or 401k. So what we're going to be covering today in terms of why this product has been available. It's been available since 1974, part of the ERISA Act passed by Congress in 1974. So it's not a new concept. I know it's gained a lot of popularity as a result of the downturn in the market in 2007, 2008. You consult with most of your attorneys and accountants. They're not familiar with the self-directed plan, but once again, a lot of these professionals are basically coming up to speed to learn more about this plan to be able to offer this as an alternative investment strategy to their clients. Your financial planner wasn't trained on this area or this aspect of the tax code. So once again, you may be consulting with some of your tax professionals as well as financial professionals when it comes to a self-directed plan, because once again, this is not their niche or their expertise. They're usually maybe going to deter you from this because keep in mind, your average financial planner or advisor usually are compensated based on asset under management. With a self-directed plan, because you're basically taking on the role to choose your investments, you're usually going to be paying an annual fee or custodial fee just for us to maintain the IRS reporting and their bookkeeping relative to the investments and cash that you're holding in the retirement plan. So it gives you a lot of power as the account holder to be able to take control of your investment portfolio and really grow it, and basically put yourself in a position to, if possible, to be able to retire at the age 65 if you choose. Your current custodian may offer a self-directed IRA, but the question is it a truly self-directed plan? If you were to contact your current plan and ask them, can you directly invest in real estate, and not invest in some form of a fund, but to actually purchase or acquire real estate by your IRA or 401k, where the actual IRA or 401k holds title to the property, the answer is going to be no, because their plan agreement does not allow for the plans that they offer to offer you the ability to acquire certain alternative investments such as real estate directly owned by the plan. Diversification is key, and this is something that's really important. Once again, it's nice to own stocks, bonds, annuities, CDs, and whatnot in terms of your traditional investments, but the true objective here is to diversify your investment portfolio. Once again, $4.7 trillion in retirement assets and IRAs, most invested in Wall Street. That's something that has to change. The majority of those funds are invested in some of your traditional investments, such as mutual funds, CDs, so on and so forth. A lot of the different investments we've heard over generation after generation, but there's definitely a whole host of different investment opportunities that's available using the self-directed plan, which I'll get into in some future slides here. Our motto in the self-directed IRA 401k industry is invest in what you know and understand. I like to believe that all of us have the ability or have a niche or a knack to be able to invest in something that we know and understand. And these four categories are some of the more popular categories that most of our clients who are opening a self-directed plan are investing in. Real estate, I would say, would be the #1 asset class that most of our clients are investing in, whether it be single-family residence, commercial, raw land, you name it. And we even have some clients that are actually investing in foreign real estate. So you do not have any restrictions as it relates to investing in foreign real estate. But one of the things I'm going to stress is to make sure that you have a team assembled to make sure you have the guidance and the knowledge in terms of being able to invest in foreign countries, to make sure that the rules here in the U.S. relative to your IRS, the IRS code 4975 does not conflict with some of your foreign laws, but the option is definitely available to you. Precious metals, that's something that was real popular, I say, up until about 2010. It was a pretty hot market. Some say that precious metals is going to be on the rise again, depending on what happens with the traditional investments in Wall Street. As we know, usually when there's a decline in terms of traditional investments or any kind of collapse or potential downturn in terms of the dollar, a lot of clients are usually looking to invest in precious metals. That's, once again, totally up to you. That's a choice that's available to you if you choose to go that route. Private notes and loans, that also kind of go hand in hand with real estate. Whether you're looking to invest directly in real estate, secured by a deed of trust or some form of security instrument held by that property, you also have the option to be able to create or loan money through your self-directed plan secured by a UCC1. Depending on which custodian you're working with, as a result of some problems as it relates to unsecured notes, you may not have the ability to directly invest in unsecured promissory notes through many of the custodians based on some recent changes and guidelines within these custodians based on some litigation that occurred over the last 2 to 3 years. But one of the options you have available to you is to be able to establish a checkbook LLC to be able to directly invest. Once again, it's not prohibited to basically invest in an unsecured note, but you may have some restrictions depending on the custodian that you choose. One of the basically options that we offer is to be able to use the UCC1 if they're not going to secure the note by a deed of trust. Private companies. There's a lot of organizations, especially as a result of the emergence of crowdfunding, which was passed back in 2012, but basically enacted based on some of the rules that basically were put in place back in October 2013, basically allowing you to publicly solicit funds, where in the past you have to go through a planner advisor and a lot of different rules in setting up a PPM. You're now able to basically go out and solicit funds publicly. So that's something that, as a self-directed IRA industry, we're basically looking to work hand in hand with a lot of crowdfunding portals and those who are looking to offer private placements to be able to invest through private placements using a self-directed plan. Now, this could be a little bit risky, so it's really important that you do your due diligence, because in essence, if you're investing in a private placement or a private company, you want to make sure that you're getting some kind of security or some type of collateral, whether it be stock certificate, share certificate, something of the sort, because in essence, even if you're investing in a real estate fund, that fund owns the property, not you per se. So it's really important that you perform your due diligence to make sure that that organization that you're looking to invest with is actually investing the money as it should be invested. But once again, you definitely have that option available to you. So these are some of the, I would say, investment options you have available to you, but this is not a total list. But I'm sure if you were to look at this list, contact your current plan advisor or a financial planner advisor and ask them, are some of these options available using your current IRA or 401k? I'm sure the answer would be no. This kind of should basically open your eyes in terms of the different options that you have available to you with the self-directed plan. So we've talked about all the good pros and cons about the self-directed plan. So there's a certain set of rules that have to be followed in terms of making sure that you as the IRA account holder or 401k account holder remains arm's length. And based on Internal Revenue Code 4975, which basically encompasses all the rules relative to prohibited transaction, these are some of the rules that you have to follow to make sure that you remain compliant, or your transactions remain compliant, as well as your IRA or 401k does not become disqualified and taxed and penalized. Just kind of read off the list here. An IRA cannot engage in any transaction directly or indirectly with anyone or anything considered related to the IRA. Some examples are prohibited transactions are selling and exchanging and leasing property, lending money, or extending credit. These are all fine as long as you're not basically doing business with yourself as the account holder or working with any other disqualified person. And I'm going to talk about who's a disqualified person on the next slide. Two key points with the IRA is no self-dealing, no personal use. So if you're looking to acquire real estate, it's really important that that property is going to be used for investment purposes only. It cannot be used for you and your family to take advantage of it for a vacation home or to lease or rent it out to certain family members. There's going to be a list I'm going to cover in terms of who can and cannot live in that property, or who you cannot do business with on the next slide. So these are some examples of disqualified persons. You as the account holder and your spouse, lineal descendants and their spouses, any fiduciary to the IRA. So normally if you have a relationship with your accountant or CPA, as long as they're not part of the transaction, you're fine with basically doing business with them. But if they're part of the transaction, so you could not, for example, go into partnership on a transaction with your CPA and or attorney, especially if he or she is representing you on the transaction. Anyone providing services to the IRA, I know when I go out and do the presentations live, or as well as do presentations via the webinar, because I have a SEP IRA in which I've been loaning money out of my SEP IRA secured by a deed of trust in terms of short-term transactions, 6 to 9 months. I'm charging usually anywhere from 12 to 14%. I get calls usually after my presentation seeking the ability to do business. Now, if I'm not the custodian in terms of representing your account, and if I like the deal, I can actually do business with you. But if you were to open up an account with Accuplan, I would be considered a disqualified person and cannot work with you. Now, one of the questions that usually come up a lot, because I know I work with a lot of small and medium-sized businesses, if the individual has a stake or ownership interest in an existing business, could they actually do business with the IRA or 401k? The answer is yes and no, and it's all dependent upon what percentage of ownership and control that that individual and his or her spouse has in that corporation or that entity. So the rule is, as long as you as a disqualified person have less than a 50% controlling interest combined with your spouse, then you should be fine. You want to make sure that any transaction or any transactional documents that are signed are usually signed by a partner. You or your spouse cannot sign on behalf of that entity to do business with your IRA or 401k. Prohibited transaction, this is something that's really important, that when you're setting up your account, you are signing your paperwork in terms of making sure monies are not commingled with personal funds, with IRA funds. This is an example of a transaction that happened last year where there was commingling of personal funds and IRA funds, and they attempted to use personal funds to satisfy the escrow deposit, and assuming that if they pulled the money out of the escrow account prior to the close of the transaction, it would be fine. Well, unfortunately, what happens is the title escrow company is required to basically to make an accounting of all incoming and outgoing funds. So what happens, if you see here in the credit column, shows two transactions reflecting the $3,000 escrow deposit. So what happened here is, if you notice, one shows as a debit here on the left side. They entered the money in, they pulled it out, and assumed that once we close, that they're going to be fine. Unfortunately, what we have to do here is almost cancel this transaction. So we end up figuring out a way to basically save this deal, because this person would have lost the escrow deposit and, of course, lost a great deal. So what we have to do in this situation, and it's not something that's always going to be available to you, is we have to cancel this escrow account, reopen a new escrow account with only IRA funds for the escrow deposit. So in summary here, you cannot just simply actually add funds into this account and pull it out, because the title escrow company usually has to account for every dime that goes in and out of the escrow account. And if we see it in their compliance department, we're going to cancel it because it's considered commingling of funds, which is a prohibited transaction. So it's really important not to commingle funds. And I usually would say work with someone who's basically done this before. REO resellers have worked with several IRA custodians, including ourselves, so they pretty much know the rules. And any of the rules that they're not familiar with, they are not shy about picking up the phone to get the information that's required to make sure that this is a sound deal and that everything's going to be above board and it's not going to put the client's IRA or 401k in jeopardy of being penalized and disqualified. So make sure you select the right partners in terms of making sure they understand the rules, or at least open to be able to, as you move forward, consult with myself and any other tax professional to make sure that your transaction is structured properly and compliantly. So in essence, you really don't want to mess with the IRS. I know based on some recent publications I've read that the self-directed plan is under a lot of scrutiny. When I say a lot of scrutiny, because it's become real popular since 2007, 2008. So they're looking a lot closer at, in particular, the self-directed plan in conjunction with the LLC to make sure that there is no self-dealing and no prohibited transactions occurring within these transactions. So just make sure you follow the rules and you should be fine. So the question is, once you establish your account, how do you actually get funds into the self-directed plan? So these are the four options you have to be able to fund your self-directed IRA or 401k. The first being the transfer, which is usually the involvement of transferring funds from your existing IRA, whether it be a traditional traditional Roth or a SEP IRA, and transfer those funds over to your new plan with us. It does not require you just pulling funds out directly that could trigger a taxable event. It usually involves a document, a transfer form, where we initiate the transfer after we receive the signed document on your behalf, and within 7 to 10 business days, the funds are then transferred via wire or via check into your new account. A rollover is usually synonymous with a employer-sponsored plan, such as a 401k, a pension plan, 403b. You can either do a rollover, a direct rollover, or a regular rollover, and the difference is usually depending on the existing custodian that you're with, and they usually set their own rules as to whether it's going to be direct or just a general rollover. The funds could be cut directly to you, in which you have 60 days to get those funds into another retirement plan. At the 61st day, if it's not deposited into another retirement plan, you're going to be subject to both tax as well as an early distribution penalty if you're under the age of 59 and a half. So it's really important that you know that that 60-day rule is not a non-negotiable time period, so you want to make sure those funds are rolled over within that 60-day period. The other option, depending on that custodian, they can always just send the check directly to us, but even then, you want to make sure that that check does reach us within that 60 days, because automatically when that rollover check is cut, they are generating documentation to the IRS indicating that a rollover has been conducted, and usually once we receive the funds, part of our reporting requirements is to contact IRS to let them know that we received these funds within a 60-day period to make sure that it's not a taxable event. Contribution, depending on the plan that you choose, and we'll talk about the different plan types that are all self-directed that you may choose from after consulting with your tax professional in terms of what's best for you. Contribution is usually relative to the type of plan that you're going to be choosing, and you have a maximum up to that amount that you contribute each tax year. So each tax year could be the same or it could change, but it's really important before you make a contribution into the plan, which is usually out-of-pocket funds, that you consult with your tax professional, because there is what's called an excess contribution penalty of 6% if you contribute too much. So a lot of plans will talk about you have a $5,000 or $25,000 or $50,000 contribution limit. Well, it's usually up to that amount. Not everyone is going to be eligible to contribute the full amount based on what's called modified adjusted gross income. So it's really important to find out what your contribution limit is for that particular year, and the only person can usually determine that is your tax professional, such as a CPA or whoever's preparing your taxes. The conversion is usually the transfer or rollover of funds from a tax-deferred account to a Roth IRA or a Roth 401k. And it's mainly moving money from a tax-deferred status over to a tax-free status. And usually you have the ability to take advantage of that option. I know a lot of my clients are kind of concerned about where the tax is going to be in the future, so they're definitely looking to move either all their funds or a portion of their funds over from a tax-deferred status over to a tax-free status into a Roth IRA or Roth 401k. You definitely want to also consult with your tax professional to make sure that this is the best choice for you, because once again, there could be tax implications as it relates to you basically going into a higher tax bracket, because that income is going to be treated as additional income on top of whatever you earn through your normal sources of income for your family. So definitely check with your tax professional in terms of if this is an option for you, whether it be a full conversion or a partial conversion. So these are the type of plans that's available. Once again, all of these plans are self-directed. The only difference is that you have only 2 restrictions. You cannot invest in life insurance and or collectibles. So just kind of give you an idea, the sky's the limit outside of those 2 restrictions using any one of these plan types that are all self-directed. These are the contribution limits for 2013 as well as 2014. So once again, these are the maximum contribution limits. You definitely want to check with your tax professional to determine what are your contribution limits relative to you personally, not based on what the plan maximum is. If you have any more detailed questions on each one of these plans, I'm going to go through real briefly in terms of what each plan represents, and then if you have any questions on any specific plan, feel free to give me a call or send me an email. Your traditional IRA is a tax-deferred account. Once again, contribution limit is up to $5,500. Roth is the equivalent of a traditional IRA. It is not a tax-deferred plan, so any growth that you realize once you've reached the age of 59 and a half and you've had the plan for at least 5 years, then you're not subject to pay any income tax on the growth of the plan. So, for example, if you open this plan with $5,500, you've already paid taxes because it's more likely a contribution. Now, any growth that you realize prior to you having that plan for at least 5 years and you're 59 and a half, then you're subject to pay any taxes. So you have to make sure you reach both milestones of both 5 years and 59 and a half before you're able to pull funds out tax-free and not have to worry about being taxed or penalized. A SEP IRA is what they consider an employer-sponsored plan for your small and medium-sized business, usually partners and or spouses running a small or medium-sized business with no employees. These are your contribution limits for the SEP IRA, once again, up to $51,000. On the traditional and the Roth, there is a $1,000 catch-up, so if you're over the age of 50 and a half, you can actually contribute up to $6,500, so an additional $1,000 allowable each year if you're over the age of 50 and a half. A simple IRA is a tax-deferred plan where you can contribute up to $12,000. This is usually for those small or medium-sized business with less than 100 employees. So if you have a small or medium-sized business and you want to get as close as you can to be able to offer a self-directed plan to your employees as well as for yourself, and you have 100 employees or less, this is a good plan to consider as well. The Solo K. This is something that's real popular, and this is for your small and medium-sized business or for those who are 1099 or self-employed. Some say, well, this contribution limits are pretty much the same as a SEP IRA. What usually set these two plans aside is the fact that you have the ability with any 401k to be able to borrow from the 401k. You do not have the ability to borrow from an IRA. Number two, if you're looking to take on any type of leverage financing, because of an employer-sponsored plan being exempt from what they call unrelated debt finance income tax, the 401k is exempt from that tax. So if you're looking to take on leverage financing in conjunction with your retirement plan, so if you're looking to purchase a property for $100,000 using $50,000 from leverage financing, $50,000 from the actual retirement plan, the $50,000 is usually going to be subjected to unrelated debt finance income tax if it's not a solo K or 401k plan. So something to consider once again if you're looking to kind of differentiate between the SEP IRA and the solo K or 401k. So some other investment options is partnering being an LLC. This is something that for those who are looking to purchase multiple properties, grant monies out of their loan in terms of secured by real estate or unsecured, setting up an LLC is an option for you. The other option, once again, is if you're looking to partner IRAs or partner between an IRA or private funds, you can also use this option, investment options such as that, to be able to acquire the property. I know some say, well, I thought the rules that you can't partner with yourself. Well, there's a set of rules that basically exempt the transaction from penalization or taxes as long as the transaction is not owned by the IRA or the account holder. For more information on that, please give me a call or email, and I'll send you over the information if that's something you're looking to do, because I know a lot of situations that maybe someone doesn't have enough money in their IRA or 401k, but partnering is definitely an option, whether it be with two IRAs or 401ks or a combination of all of the above, including personal funds. So we talked briefly about the non-recourse loan, so don't have a lot of time to go into that, but there's a list that I can provide you if you're looking to use leverage financing in terms of acquiring real estate. And what that is really is the ability to use your IRA to obtain a loan. The loan is actually granted to the IRA, not to you personally. There's what they call a portfolio loan, in which the loan is granted to the IRA, and the only recourse in the event of default is against the subject property owned by the IRA. So funding a real estate investment, all it requires is for you to establish an account with us. Usually if it's done online, we can get the account set up same day. Once the account's established, you're going to fund the account via transfer, rollover, or contribution, whichever you choose, or a combination of all of the above. You're going to complete some of our internal forms, such as the direction of investment, which basically authorizes us and to basically take specific instructions on how you want to fund your transaction. And usually within, say, 3 business days from receipt of all the transaction documents and our authorization forms, we can actually fund your investment. So it's a pretty straightforward and, I would say, easy transaction, as long as everything is above board and everything is set up compliantly. But that's something that we're here for, is to make sure that as the documentation comes in, everything is a smooth transition. We're going to be communicating with yourself as well as any other professional is going to be representing you to make sure that your transaction experience is going to be as seamless as possible. So yeah, once again, we received the purchase contract and everything is ready to go within 3 business days as long as there's no error. So that's pretty much what it would look like. This is a flow chart to kind of give you an idea of what the process would look like. So if you have any questions, feel free to give me a call. I want to just real quick summary. IRAs can hold all types of investments, not just securities. So it's really important to think outside of the box for 2014. Partnerships and split ownerships are allowed, which I kind of alluded to on the last slide. If you want more information in terms of different structures of partnerships in terms of acquiring real estate, please give me a call. IRAs and solo Ks can grow tax-deferred or tax-free. So once again, we can talk about the different types of plans. You want to consult with your tax professional to make sure that whichever plan you choose that you're eligible and it's going to be best for you personally. All plans qualify for partial transfers and conversions. So once again, this is something that's really important. If you're looking to go from a tax-deferred status to a tax-free status, you're not required to convert all the funds. You can also do a partial conversion. So whatever fits your budget in terms of what you want to basically take on in terms of a tax liability, you have that option. Transfers. moving monies from one IRA to another. You have the option to move all or a portion of your funds. So once again, it gives you that flexibility to truly diversify your portfolio. So if you want to come back get additional funds later, you also have that option that's available to you. What's really important is to establish and fund your account prior to entering into any type of contract, because it's pretty competitive out there. And I've seen a lot of clients lose deals because they have gone out, tried to go into contract, which is prohibited under your name, and attempting to transfer the contract from your name personally to the IRA. You're required to have a legal IRA vesting to go into contract. An addendum cannot fix, or should I say patch the problem in terms of making sure that the contract is set up for the IRA. It has to start out in the name of the IRA vesting in order for it to be a compliant transaction. So here's my contact information. That's pretty much my presentation for today, and I'll leave my slide up, and we'll go ahead and open this segment up for a Q&A session. Charlie?
Yeah, thanks so much, Lamar. That was a lot of great information. As we're waiting for questions to come into the queue here, there's a couple things that stuck out to me, Lamar. First thing is crowdfunding. Have you had any experience with that as yet?
Actually, there's a webinar that I actually did with a guy who's kind of been in venture capital and angel investing for the last 25, 30 years, and I'm actually in talks with some organizations that want to work with me in terms of promoting different investments through crowdfunding portals. So that's kind of work in progress, considering the legislation was just finalized back in October, so a lot of people are really trying to put their deals together, or should I say their platform, in order to move forward to make sure everything is compliant.
I'd like to talk to you about that myself, so maybe offline we can chat about that. And as well, there was another thing that stuck out to me too. I've been doing these webinars now for about 4 years, and I don't know if I've done more than 5 in all that period of time where someone didn't ask me about non-recourse lending, and I've not been able to identify someone yet that I don't want to say is legitimate, or where I've just not found any non-recourse lender yet that I would recommend to somebody. And so I get asked the question all the time. I know as you mentioned it here, I'd love to talk to you about that as well, because I have a slew of clients.
Yeah, and I have a list. I have a list that I usually will send out, as a courtesy to any client or prospective clients. And matter of fact, after this call, I'll send it over to you. But I'm actually working actively with 3 of the lenders on that list, where I'm working with a business partner out of North Dakota, which almost, I would say, getting 90% of the transactions is basically requiring, or not a requirement, but it basically involves non-recourse lending.
Yeah, I'd love to have that list. I appreciate that. Okay, we've got a couple here popped up. First of all, for those that are asking about the video, today's video, we did record today's webinar. So if you would like a copy of it, there was a lot of information there, Lamar. You did a really excellent job of giving a lot of detailed information in less than 35 minutes. So many of you are going to have questions and probably would like to view this again. So for those that are asking for the video, just raise your hand. Let me know you'd like to have a copy of it. I will be glad to send it off to you. It typically takes us several hours to load it into YouTube and then send it out. But we will absolutely, for those that want it, we will absolutely send you a copy of today's webinar. Just a couple questions, Lamar. I think they're directed at you. At Accuplan, what are the fees to manage a self-directed IRA?
For a real estate transaction, we have a general fee schedule which applies to a variation of different investment types and structures. But for a real estate investment, the fees would be as follows. It would be a $50 one-time setup fee, a $275 annual fee. There is a required minimum balance to maintain the account, to keep the account open of $325. So if you're looking to transfer funds over, factor in to leave at least $325 in the account. And then there's your wire fees of $15 for incoming and outgoing. You receive 6 free transactions. Thereafter, each transaction, in terms of acquisition of an asset, is $35 per transaction. You receive 12 free transactions per year. After 12 transactions incoming, then it's $10 per transaction. And that's pretty much what your fee structure will look for a real estate investment.
Okay, what is the typical price range of single-family resident purchases in Atlanta? Okay, the Atlanta market, I was profiling Memphis and Birmingham today. In both those markets, you can buy in as little as, $35,000 up to $75,000, $80,000. In Atlanta, that's where you sort of start. In the majority of the inventory you're going to find in Atlanta is going to start around 60, 70 and go up to 120, 130,000. It's just a different price range there. As I mentioned, the cap rates won't be as high. The appreciation can be very good, but the cap rates won't be as high in Atlanta. But if you're interested in Atlanta, we say Atlanta inventory. Next question, this is to you, Lamar, and this is what we're just talking about. What type of financing is available for houses purchased through a self-directed IRA, and then how much of a down payment would be typically required?
Well,
let's just say the house is $50,000. What kind of down payment does somebody have to have for something like that?
On average, it's usually 50%, but you have some lenders, and this is where things have gotten a lot competitive, really competitive over the last 12 months. It was pretty much standard 50% loan to value, but you have some that are going up as high as 65, 75%, and there's compensating factors. You may start off with a benchmark of 50% loan to value, but they could look at different compensating factors such as where the property is located, the propensity for the higher ROI, and then also what you really want to make sure with a non-recourse loan is kind of one of those unspoken words. They usually want to see a copy of your retirement account statement. So the more you can show in the retirement account statement, on your statement, the better. Even if you're transferring over, say, $100,000 for a property, and if you have $400,000 or access up to $400,000, and you want to receive either a better rate or a higher LTV, transfer all the funds over to the retirement account. Once the transaction closes, you can transfer over back to wherever you want to transfer the funds, because the main thing is you want to show that lender, in the event you can't find a renter for 6 to 12 months, you have more than enough resource to pay the mortgage. So that's something to consider.
Okay, rehab costs and tax impact. I'll do those one at a time. Rehab costs generally, as I mentioned during the webinar, should not be more than 10%. In other words, if it's a $50,000 house, you shouldn't be doing more than $5,000 in rehab work in the house. Now, that's not a rule. That's not the golden rule. There's certainly some properties that are worth making a greater investment in rehab costs than that. But generally, any of the wholesalers that I work with, none of them are going to take on a project where they're, buying a house for $30,000 and it needs $30,000 in rehab. And the reason for that is simply this: when you get into some of those larger type of rehab jobs, you're going to come across things you didn't expect. So it's rare that you're going to actually hit the number that you think is actually your rehab cost. In other words, I'm estimating $20,000 for rehab costs. Well, you get into it, and the next thing you know, you're spending $30,000 in rehab costs. And that's where generally people have made mistakes in trying to do flips, is they get into a project and they underestimated the cost of the rehab. Now, the homes that I featured today, and for the most part, and I'm talking about 99.9% of the time, the house is already going to be rehabbed. So the prices that I quoted, those are including rehab costs. In other words, those properties that you saw today and the other ones that I have available, those are rehab. They're complete. So when I say the price is $49,900, that means it's $49,900. It's rehabbed. There's going to be a renter installed in it. You're not tenant. It's what I call turnkey. So there isn't any rehab cost to you. Now, if you want to do a flip, where you want to do something where you buy it wholesale from a wholesaler and then you invest the money in the rehab, we can talk about that. That's not a strategy that I'm in love with. I would much rather say, there's the property, it's rehabbed, it's rented, it's cash flowing, and there's a property management team in place, and there's no more work to be done to it. Matter of fact, it comes along with the closing, a 1-year guarantee on all the rehab work, along with a home warranty. So that's how we prefer to sell inventory. Tax impact, there's a lot of tax benefits, and I'd rather do that offline. I'm not a tax accountant. Lamar would be far more qualified to answer that question than I would. I do know, though, that there are many people that invest in real estate because of the tax benefits that are involved for them, and that can be anything from travel to being able to write off repairs and all that sort of stuff. But there's tremendous tax benefits. Be looking for our webinar. We'll be doing that with a tax professional next Thursday. We can talk more about that then.
Okay, any other questions?
Yeah, Lamar, one more. Could you go over the conversion process from a 403B to a Roth IRA?
From a 403B to a Roth IRA. I guess the question would be, in order to convert that over, you have to be 1099 or self-employed. Other than that, it would have to be rolled over from that existing plan over to the new plan into usually a traditional IRA or SEP IRA, whatever the case may be. But if the person is looking to move those funds over, if they're self-employed, then it's just to be a matter of no different than moving monies from one custodian to another. It's going to be pretty much a rollover from that existing plan to the new plan. And usually it takes 7 to 10 business days for that to take place.
Okay, do we have any more questions in there? I don't see any other questions in the queue. I'll leave our phone numbers up here. We had left Lamar's up there for a bit. I'm going to leave mine up there as well. You're more than welcome to give us either myself or Lamar a call. We have another one today at 3 o'clock with Lamar. Lamar, thanks for doing that. And we have another one on Thursday at noon with Brian Davis with Accuplan down in San Diego. So look if you can join us for any of those as well. And again, I'll leave our information up here. Hey, Lamar, thanks so much. That was great information. Appreciate you being here today.
Okay, thank you, and everyone have a great day. Thank you.
Thank you.